Hey everyone, it's Jerry here, and today we're diving into the exciting world of stock options, specifically the concept of in-the-money options. Whether you're new to investing or looking to broaden your knowledge, this video is your stepping stone to understanding options without getting overwhelmed. Let's kick things off with what in-the-money option means. Imagine you've got a golden ticket. That's an in-the-money option. It's your opportunity to buy or sell a stock at a price that's already profitable. For call options, this means you can buy the stock for less than its current market price. For put options, you're able to sell for more than the market rate. Options aren't just about stocks. They can be for bonds, commodities, you name it. But they're popular with stocks for a good reason. They offer you the chance, but not the obligation, to buy or sell at a set price, known as the strike price, by a certain date. Every option comes with a price called a premium. This isn't a random number. It's influenced by the market price of the stock, how much time is left until the option expires, and how the strike price compares to the stock's current market price. Now, let's talk turkey with call options. You're bullish, expecting the stock to rise. If the market price soars above your strike price, you're sitting pretty with an in-the-money option. The difference between the market price and your strike price, that's your intrinsic value, and it's what makes an option truly valuable. On the flip side, put options are your best friend when you expect the stock to fall. If the strike price is above the market price, your option is in the money. You want the stock to drop enough to cover your premium and then some, leading to a profit. Everything has its ups and downs. ITM or in-the-money options might be more expensive due to their built-in profit potential, but they also come with the chance to make a tidy sum if the market moves in your favor. However, don't forget about those premiums and fees. They can eat into your profits. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Let's dissect a more nuanced scenario with our hypothetical stock, Tech Forward. Imagine you're eyeing a call option for Tech Forward with a strike price of $100, while the current market price is $105. This option is clearly in the money, meaning if you exercise your option, you can buy shares at $100, a bargain compared to the market price. But why stop at understanding just the basics? As an investor, I often lean towards buying call options with around a 0.7 delta, and here's the scoop on why I like a 0.7 delta. It indicates that for every $1 move in the stock's price, the option price is expected to move by about 70 cents. This sweet spot means the option is responsive enough to price changes to be profitable, yet not so volatile that it's like a high-stakes gamble. It strikes a balance, offering a potential for significant profit while mitigating some risks associated with options trading. Why does this matter to you, the investor? When you choose an ITM option with a 0.7 delta, you're essentially opting for an investment that's expected to move closely with the stock, but with the added leverage options provide. This leverage allows for greater profit potential compared to owning the stock outright. However, this strategy is not without its nuances. The cost of the option, or the premium, plays a crucial role. Returning to our Tech Forward example, if the premium is high, it could offset your potential profits. Thus, while the allure of in-the-money options with a 0.7 delta is strong due to their favorable balance of risk and responsiveness, the key to unlocking their potential lies in meticulous analysis and timing. It's not just about picking any in-the-money option. It's about finding those with the right delta that aligns with your market outlook and risk tolerance, ensuring you're positioned for profitability even after accounting for premiums and other trading costs. And there you have it, folks. You're now familiar with in-the-money options. Next up, we'll explore out-of-the-money options, so stay tuned for more insights that'll help you navigate the stock market like a pro. Keep it real, and I'll see you on the next video.